Hi, this is Tim Kelly from LTC Breakthrough, and thank you for joining us today. This is our free educational webinar series entitled Long-Term Care Insurance 101, the basic building blocks, and this is the second in our 5-part series. So if you haven't watched the first video yet for the monthly benefit, then please go back and watch that prior to watching this video. Thank you. Prior to purchasing any long-term care insurance, you want to make sure you go to our website, ltcbreakthrough.com, and request an individual phone consultation. So without further ado, let's get started. So again, the basic building blocks, there's 5 of them. We've already done the monthly benefit in video 1. And in this video, we will be discussing the benefit period. In future videos, we'll be discussing the elimination period, the inflation options, and the benefit triggers. So the benefit period. You have options of anywhere from 2 through 6 years or lifetime benefits in most policies as a decision you'll have to make in terms of how long you want your monthly benefit to be paid to you. Lifetime benefits means that your benefits never run out. So in our example here, where we have a monthly benefit of $5,000, they would pay you that $5,000 forever and your benefits would never run out. Now, the benefit period for most people, they select anywhere between 3, 4, or 5 years in your benefit period. And I want to make sure you understand exactly how this works. It doesn't mean necessarily that if you have a $5,000 monthly benefit and you select a 4-year benefit period in our example here, or 48 months, that your benefits will necessarily run out in 4 years. So as an example as to how this works, you take your monthly benefit in our example of $5,000, you multiply it by 48 months or 4 years, and you have a lifetime maximum of $240,000. Now, to be clear, your policy ends when that $240,000 gets to 0. Think of it like a long-term care checking account that you have access to, and you can get up to $5,000 per month. And when that $240,000 gets to 0, in other words, when you have nothing left in your checking account, your policy will terminate. So as an example, if you have a bill of $4,000 in 1 month because you're receiving, let's say, home health care, you could pay that $4,000 in that bill, and that $1,000 will be saved to be used later. So your $240,000 would be reduced by the $4,000 bill. You'd have $236,000 left. You kept the $1,000 in there, so it will extend how long your benefit period lasts. Now, if you have a cash benefit, remember in your cash benefits, if you listen to video 1, you will get the full $5,000 every month, and your benefits will run out in that 4-year period of time with a cash benefit. Now, any money that you don't use in those cash benefits, you can put in your bank account or do with it whatever you choose. So again, 2 through 6 years or lifetime benefits are the options in the policies today. Most people select 3, 4, or 5 years. And the reason for that is we know, and this can help you a little bit to decide what benefit period to select, is that long-term care claims, the amount of time that you actually need care, only about 10% of claims last longer than 5 years. I'll say that again, only about 10% of claims last longer than 5 years. So you can cover the vast majority of your risk with a 5-year benefit period that equates to 60 months But again, most people select 3, 4, or 5 years depending upon their budget. One of the riders that I wanted to discuss with you that has to do with the benefit period is called the shared benefit rider, and this is for couples. So in our example, if you had a $240,000 lifetime maximum and your spouse also had $240,000, you would actually share $480,000. Now the benefit of that is that if you actually used up all of your benefits in your policy, but you still needed care, then you could actually start dipping into your spouse's $240,000 in order to continue to have your claims paid by the insurance company. Now, this is a very popular benefit inside long-term care insurance policies. The other great benefit is that if your spouse passes away and doesn't use their benefits, you would be allowed to keep all of those benefits, all of your unused spouse's benefits, and you only pay your premium from that point going forward. So it's a fantastic benefit for couples, and it works really well because one of you is really likely to need long-term care services, whereas it's less likely that both of you will need them. So it just makes sense logically to share benefits instead of having your own individual lifetime maximums that you can't share. So adding this shared benefit rider is very beneficial for couples. Now the rider's not free. It generally will add about 10 to 20% to the premium, and that depends on your total lifetime maximum as to how much this rider will cost. But you can offset some of that cost by reducing your benefit periods. So in our example, where you had a 4-year benefit period or 48 months, maybe each of you could purchase 3 years and add the rider so that now you're sharing 6 years instead of just having your own 3 years each. And by reducing your benefit period from 4 years to 3 years each, you can actually offset the cost of the rider. It will cost about the same, but you'll be sharing 3 years each. So you'll have 6 years to tap into for each of you. And again, one of the great benefits of this rider is that if one of you passes away, your surviving spouse gets to keep all of those benefits that you didn't use, and you only pay your premium on a go-forward basis. So this is a fantastic rider for couples. Thank you very much. Here's some of our contact information. Again, my name is Tim Kelly. Our phone number is 888-909-8833. You can go to ltcbreakthrough.com, or you can email me at tim@ltcbreakthrough.com. Again, please don't purchase long-term care insurance prior to speaking with us first. Go to ltcbreakthrough.com and schedule your individual phone consultation. I'm also going to put a link below in the description to the website. Thank you very much and have a great day.